My name is Matt Williams. I am the head of derivatives at Luxor Technology. I came to the firm in May of this year, having come over from the National Futures Association, which is a self-regulatory organization in the derivative space. Prior to the NFA, I spent 5 years at CME Group on the corporate strategy side of things and also as a team member of the CME Ventures Group. And before that, I spent several years as a trader, both in the energy and agriculture space. More than happy to answer any questions you might have about Luxor's new Hashprice derivatives. Yeah, I would be more than happy to explain what Hashprice is. So in the mining community, you can think of Bitcoin miners as producers of hash rate. And essentially, the term that they're paid for that hash rate is hash price, which is actually a term coined by Luxor. Hash price is essentially a component of four main pieces. So you have Bitcoin price, block subsidy, transaction fees, and network difficulty. And as such, the hash price movement is dependent on those four components. So, for example, the higher the block subsidy and higher transaction fees and higher Bitcoin price, the higher hash price is going to be, and vice versa for a lower hash price. Network difficulty as one of the four components works in the opposite direction for hash price. So the more mining that's on the network, the higher the network hash rate, the smaller the slice miners will get from Bitcoin's fixed issuance schedule. And as such, the higher the difficulty, the more adverse effect you would have on hash price. So Luxor has produced a hash price index that's been around for quite a while and is widely used and referenced in the Bitcoin mining community. And as such, we're going to use that as the benchmark for this newly launched derivative. So to understand what a non-deliverable forward is, you have to take a small step back and talk about forward contracts. So forward contracts, or forwards for short, are really one of the oldest and simplest forms of financial derivatives, and you can see them in pretty much any asset class out there. A forward contract is essentially a contract made between two parties and typically has one of two outcomes. The first and very commonly used is a physically delivered forward, and the second being a cash settlement. So in a physically delivered contract, one party agrees to buy a commodity on a future date and at a fixed price, while the other party agrees to deliver that commodity at a future date and also at that same fixed price. There's actually a few examples of these type of forwards for hash rate that exist today. Luxor is going a bit different, so we are using what's called a non-deliverable forward, which is a cash settled forward, also referred to as an NDF. The difference between the fixed price of the contract and the settlement value of the underlying commodity at the expiration of the contract is paid out in cash from one party to another. So rather than having the physical component, everything is based off of an index, in this case, settled to that index and only paid at the end in a cash settlement. So the way this contract is structured starts with Luxor. So Luxor facilitates these trades essentially by matching counterparties, promoting price discovery, managing counterparty risk, and then providing tools for daily profit and loss calculation. We also act as a settlement agent as the contract is settled to Luxor's Bitcoin hash price index. So essentially, the first step is onboarding with Luxor, and after completing that onboarding process, buyers and sellers of an NDF contract simply have to agree to three main components of this trade. So those three components are price, size, and duration. So the price is what we call unit hash price, so that's the hash price or the value of the hash rate. The size is the amount of petahash or hash rate that you would like to trade. And the duration is the time component, and typically these work in 30-day increments, although this being an over-the-counter trade could be any number of days as long as the counterparties agree to it. So using an example, suppose you have a miner who has 100 petahash of daily hash rate, and they want to hedge their entire exposure for 30 days using the Hashprice NDF. So the miner wouldn't just continue about their normal mining operation activities, but they would sell a certain amount of contracts at, say, $85 per petahash per second per day, which is the spot rate of hash price, effectively locking in their revenue for that hash rate in that time. So assuming the miner is hashing, the NDF in this example will completely hedge and lock in their revenue for that amount of hash rate. So taking that example one step further, let's say we go to the end of the contract at expiration and now hash price is at $70. They would effectively get a settlement, which is the difference of the contract that they started at, which was $85, minus the $70, and the delta of that would be paid out in cash by the other counterparty. So the miner would receive a profit in this case from the NDF, which would essentially offset any lost revenue from a negative or adverse price movement in hash price. Yeah, that's a great question. So Luxor's first hash rate derivative, which is these Hashprice NDFs, are designed to fill the unmet need in the Bitcoin mining community of a hedging instrument for hash rate. So essentially what we built is an instrument that can hedge a miner's hash rate exposure for a given amount of time and give them revenue certainty. So Bitcoin miners make natural sellers of this Hashprice NDF as they are owners of hash rate and need to hedge against adverse price movement. Conversely, buyers of this contract are those that are looking to gain exposure to hash rate without actually owning the physical assets required. So purchasing a hash rate NDF essentially allows for temporary non-physical exposure to hash rate, and that's what a buyer would be gaining in this. So other examples of Luxor or Hashprice NDF buyers would be mining companies, hosting sites, basically people waiting for ASIC procurement or operational setup and are looking for short-term exposure to hash price. On the other hand, you could say hosted miners that might be paying out a percentage of revenues to hosting providers and looking to lock in hosting costs could use this product as well. And we also have a fair amount of interest from traditional finance participants such as hedge funds, market makers, private equity, and others looking to generate alpha or to diversify their portfolio into alternative assets. So we actually get this question quite a bit. Why would a non-miner want to trade these contracts? Really, the question can be reframed as to, we understand that there's a huge need for this in terms of a hedging instrument, and the miners would be sellers of this contract, but who would be the buyers of it? We set that up as Luxor's Hashprice NDF as a great way to get alternative exposure to Bitcoin mining, and also as a great diversifier for Bitcoin price exposure. So depending on current market dynamics, buyers of Luxor's Hashprice NDF could find discounts to spot price. They could generate synthetic yield opportunities. There's a good opportunity for alpha generation as well, or even arbitrage opportunities with other Bitcoin derivatives. We've had a number of interests for people on the buy side of this for all the reasons above, but really what this does is gives you a unique opportunity to get exposure to the Bitcoin mining world without actually having to have the physical assets. Why launch a hash price derivative now? This is a great question. Again, really, I think it's a really opportune time to launch a hedging instrument for the mining community, particularly after what we've seen over the last several months. Bitcoin miners have a lot of different exposures to risk, and not all of them have hedging instruments. So, for example, on the cost side, Bitcoin miners have power purchasing agreements or other energy-specific hedging instruments that exist, be it electricity or nat gas or crude oil. And then also from a price exposure, there's a multitude of Bitcoin derivatives that exist to hedge your balance sheet. There's insurance to hedge operational risks and other ways to mitigate, different components of your exposure as a miner. However, what they don't have are a robust set of derivatives to manage their hash rate exposure and to gain revenue certainty across all their exposures. So given what we've seen in the space over the last several months, we realize that there's an unmet need for hash rate derivatives that provide miners with the ability to mitigate hash rate risk. We wanted to develop a tool to lock in revenue so you could cover OPEX or CAPEX, or as I've said before, add an alternative exposure when conditions are favorable. So as such, we believe Luxor's Hashprice NDF checks all those boxes, and the timing is fantastic to launch a hedging instrument as there's a big need for it. So I referenced the onboarding process a bit before. I'll go into a bit more detail now. So since a non-deliverable forward is technically considered a swap in the regulatory world, we have to adhere to certain regulations. So for the purpose of onboarding, all counterparties trading the Luxor Hashprice NDF must agree to certain terms that are outlined in what's called the ISDA Master Agreement. So this is essentially a standard document widely used in the swaps world to govern over-the-counter derivative transactions such as this. So the agreement, which was published by the International Swaps and Derivatives Association, ISDA, outlines the terms to be applied to a derivatives transaction between two parties. So it's essentially it's designed to be protective for both counterparties that are trading with each other. So the ISDA Master Agreement itself is standard, but it's accompanied by a couple of customized schedules and annexes that are more bespoke to the nature of the contract, and ours is the same. So, it's essentially these documents, they can be a bit overwhelming at first, as it's a lot to read through and agree to terms on. Fortunately, though, it's a one-time process. So, once a customer indicates they want to onboard with us and trade our derivatives, the Luxor derivatives team will work with you and make the onboarding process as frictionless as possible. We also provide, once you're onboarded, we provide access to our new derivatives platform, and that provides a number of capabilities for managing your new Luxor Hashprice NDFs.